All right, let's dive right in. We're here to unpack a really fundamental shift in how we all have to think about financial risk. Because in the world we live in now, that line between a simple computer bug and a full-blown global financial catastrophe, well, it's basically disappeared.
Catastrophic. On a scale of 1 to 10, this is an 11. I mean, wow. That quote was about the Heartbleed bug, which was this massive, massive flaw in the encryption that's supposed to secure most of the internet. That's the level of danger we're talking about. This isn't just about someone stealing your password. This is about the very foundation of trust our entire financial system is built on.
So, to really get a handle on this new kind of danger, we need a better way to picture it. I want you to forget what you think you know about risk for a second. The real threat today, it's like an iceberg. And we all know the deal with icebergs, right? The part that's going to sink the ship is the part you can't see.
For decades, all our fancy financial models were built to measure the stuff that was visible. You know, the day-to-day market fluctuations we could see and actually count. But that was always just the tip of the iceberg. Today, though, that huge hidden mass of risk that's lurking just beneath the surface, it's almost entirely digital. And that changes everything.
So, what happens when the very tools you're using to spot the danger are, well, flawed? This brings us right to the heart of the technical problem. Our models are seriously struggling to keep up with this new reality.
For a long, long time, the industry standard has been a model called value at risk, or just VaR for short. In simple terms, it's a tool that's supposed to predict a company's maximum potential loss on any given day. Okay, but here's the fundamental problem with VaR. It's actually great at predicting what happens on a normal, boring day, but it is terrible at modeling what experts call tail risks, those super rare catastrophic events that cause the most damage. Think of them like financial hurricanes. And in our interconnected world, those hurricanes are becoming dangerously common.
Let's see what this looks like in practice. For the exact same super safe, low-risk portfolio, two different trusted models give two very different answers. One model sees about $1.3 million in risk. The other one looks at the same thing and sees almost $1.9 million. That's a $500,000 blind spot for the exact same assets.
And look what happens when we look at a higher return portfolio. The blind spot gets even bigger. The disagreement between these two models suddenly balloons to nearly $2 million.
This raises a huge, kind of terrifying question, right? If the standard tools that banks and hedge funds are using can be off by millions of dollars, how can they, or any of us, truly know how much danger they're in?
So this deep uncertainty in our models is colliding head-on with an even bigger shift, the complete and total fusion of the digital and financial worlds.
And this leads us to what might be the single most important idea we're going to cover. In today's world, there is no meaningful distinction between cyber risk and financial risk anymore. Cyber risk isn't just another risk on the list. It has become the main event, the one that basically swallows all the others whole.
So why is that? Because our entire global financial system runs on just a handful of shared digital backbones. You've got Swift for banking, Fix and Fast for trading. Everybody's using the same hardware, the same software, the same networks. This means a single vulnerability in one of these shared systems doesn't just affect one bank. It creates a correlated systemic risk that can threaten everyone, all at once.
This forces us to accept a new reality. Any risk that's based on networked information is, in fact, a cyber risk. Think about it. Stocks, bonds, currencies. At the end of the day, what are they? They're just digital information. So any risk to that information is a financial risk. Market risk is now cyber risk. Credit risk is now cyber risk. It's all cyber risk.
And if that wasn't concerning enough, the very foundation of digital security itself, the cryptography that protects all this information, is now locked in a desperate race against time. This timeline shows you just how fast the game is changing. Back in 1977, experts thought it would take 40 quadrillion years to break a certain code. It was broken in just 17. Since then, we've seen even tougher codes fall. And now, looming on the horizon is the ultimate threat: quantum computers that could make all of our current encryption standards completely useless.
This leads to a truly chilling possibility. Based on how fast we're learning to break codes, experts suggest that it's not at all improbable that today's most widely used encryption standards might already be broken, by state-level actors, and we just don't know it yet.
So what does all this mean? It means we are in a brand new era. We've moved from a world of measurable risk to a world of just unknowable uncertainty.
So when our own models can't see the biggest threats and the very ground of digital security is shifting beneath our feet, how do we prepare?
How do we face a future where the next crisis might not come from a bank, but from a single line of code? How do you anticipate a surprise when you can't even model it in the first place?